Hello everyone, and how's it going? In the world of investment and trading, NASDAQ has always emerged head and shoulders above all the other exchanges around the world, especially for us, the retail traders, who are looking for high growth opportunities. The potentials for disrupting technologies that may redefine entire sectors of the economy, along with the possibility for exponential growth in share price, has attracted many people to begin their adventures here in order to become the titans of tomorrow, such as Apple, Amazon, Tesla, and Google. With all these precedences, it's normal for traders to also come here to navigate the exciting and yet volatile waters of the NASDAQ in order to identify a precise way to capitalize on the defining enterprises of tomorrow. After all, this is one of the birthplaces of the modern economy, where the creativity, connectivity, speed, and analysis using the tools and technologies of tomorrow. Amongst all these titles that may bring us wealth and prosperity, there is Palantir, the data analytics firm based in Denver. Palantir has been an enigmatic company ever since it went public on the NASDAQ, with a reputation shrouded in controversies. As a data aggregator and analysis platform, it has one of the deepest relationships with the public sector's entities in the industry, with healthcare, intelligence, and defense contracts at its disposal. Its price action is also directly linked with the company's own fundamentals and risk appetite of the market, and with an increasing institutional participation in the company that may have a lot more potentials to put the price to a higher place. Before today's video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, Palantir has been trading lower from its $20 ceiling in a general context of geopolitical tensions and expectation from the market for challenging the economic conditions in the month to come, coupled with a real possibility of a stock market rally due to the interest rate decrease. Meanwhile, Palantir received a one-year extension on its contract with the DoD worth $115 million, which did attract to some extent a small recovery of the pullback. Palantir has also been operating the platform called Army Vantage, of which its continual usage has recently been put into question because of some discord of the data ownership. As we're approaching the end of the year, Palantir will likely be trading on relatively lighter volume and lower volatility. Meanwhile, the company's outlook only changed marginally, with 60% of its revenue still depending on the public sector partnerships. Any ongoing decline might also be the result of the surge by about 183% over the course of 2023, as profit taking has been taking place throughout the year. With that being said, here's a quick look at the technicals. The trading volume of Palantir has been around 43 million shares, compared to an average volume of 65 million shares. Over the previous 52 weeks period, the price fluctuated between $5.84 and $21.85. The volume of shares traded tells us how many shares are being bought and sold at any given time in the market, and if there is enough liquidity to support a trading strategy. If the float is very thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for a trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, we can expect the current volume to be significantly higher than the average volume. The market cap of Palantir is currently around $40 billion, compared to an enterprise value of $15 billion. As we compare the current price to the historical price fluctuations, the stock is 5% higher than the 1-month low, 31% higher than the 3-month low, and 207% higher than the 52 weeks low. On the options market, which often gives a hint about the market sentiment on where the stock price is probably going to head next. The implied volatility is around 52% compared to a historical volatility of 53%. The put-call volume ratio is currently around 35%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 212,000 contracts a day versus the 30-day average volume of 334,000. As for open interest, the most recent volume of open interest is around 3 million contracts versus the 30-day average of 3 million contracts. Regarding the shareholder structure, institutional shareholders own about 40% of the total number of shares as a result of short selling as well as direct investment. The biggest shareholders include Vanguard, Renaissance, and BlackRock. Usually, it's always good to see some institutional participation if you want to hold a stock long term, as it demonstrates a layer of stability and reliability for the long term. It means that the market believes that this company will actually deliver on what it promises. I personally believe that a minimum threshold should be around 30% of institutional ownership. There are many exceptions to that rule, of course, as there will always be great companies for mostly owned by retail traders. The current short interest is approximately 6% of the total float and 52% of the transactions from the dark pools. Typically, if the short interest is above 15% of the total volume, with a significant portion of the shorts coming from the dark pools, it could suggest the presence of a short attack on a stock, increasing the potentials for a short squeeze. Although in this case, with just 6% of the short interest, I don't believe that this is really the case. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, overall, what is my opinion about Palantir? I think that it continues to be a company that is establishing their presence over a longer time frame and will remain relevant in the economy of tomorrow. It doesn't really mean that it will necessarily recover its previous heights in the short term, but the narrative on the company remains encouraging. A gradual increase in position over the course of the next 24 months is encouraged, while keeping in mind that there is a real possibility for Palantir to see some significant corrections in the years to come. I would recommend to commit between 3 to 5% of your portfolio in Palantir and to split the allocation in batches of 20% at a time over the next 3 to 6 months so that you may purchase more in case it retraces.